Hey everybody, welcome to another short video about multifamily investments. My name is Joseph Gozlan from Eureka Business Group, and my email is on the screen, joseph@ebgtexas.com. So before we talk about the 50% rule and what exactly it is and how to use it, let's talk about what it's good for and what it's not good for. So first of all, keep in mind that the 50% rule is a rule of thumb. It's designed for quick analysis, and it's really good for going through multiple deals in a fast pace, evaluating deals based on just limited information, sort of fill in the gap. So if you only know some of the information but not all of the information you need in order to really evaluate a property. And it's really good for B and C class properties. What it's not good enough for, it's not accurate enough to make a serious offer. It's based on assumptions that might be wrong, and in certain local submarkets, the market might behave differently, right? And it's definitely not good enough for A class and D class properties because they have different dynamics. So before we start talking about the 50% rule, let's do a quick recap on how we evaluate a multifamily property. So multifamily property, basically the formula is net operating income divided by cap rate, and that's the value of the property. NOI, net operating income, it's basically calculated by taking your operating income less your operating expenses. And operating income can be your income from rents, the application fee, the late fee, laundry income, vending machines, and so on. Operating expenses, it's your maintenance cost, it's your salaries, it's your utility bills, and so on. The cap rate is a percent that represent a local submarket supply and demand um, for properties in the class that you're buying at. So a quick sample would be if my operating income is $750,000 and some change, and my operating expenses is $352 and some change, and we know that the area cap rate is 6.5%. So it's simple math: 750,000 less 352,000 divided by 6.5, which gives us roughly $6.1 million property value. So that was a quick recap. If you want to get more details about evaluating multifamily properties, we have a full video on our YouTube channel just about this. And our YouTube channel, you can find it by going to youtube.ebgtx.com. The address will be at the end of this presentation. So how do we use the 50% rule? So the 50% rule is basically assuming that the operating expenses are going to be equal to 50% or half of the operating income. This really allows us to estimate the NOI, the net operating income, based on whatever we have. If the broker gave us a pro forma or potential rent income, or if we do a market research and we know that the rents in the area are $600 a unit and there's 10 units, right? So we can take some assumptions into place and apply the 50% rule to calculate the NOI. Given the NOI based on our assumption, then we know the cap rate in the area, and if you don't know, just work with any commercial brokerage in the area and they can help you get that number, and then you get an approximated property value. Now, most properties in the B and C class area where the tenants pay their own bills will probably fall down somewhere in the 45 to 55% operating expenses to income ratio. And that really comes from industry standards, from industry statistics that always fall into that range. Obviously, the more efficient you are in the operating model, then the lower the percentage of OPEX out of the income ratio. And if the property is in a worse condition, then you can expect more maintenance expenses and more salaries to pay for those maintenance people to do the work, so the percentage of the OPEX will go higher. The 50% rule has a variation in terms of 65% rule. And when do we use the 65% rule? Well, we use it when we're analyzing an ABP property, an all bills paid. So if you have a property where the owner pays all the bills, then we look at 65% as a rule of thumb, not 50% as a rule of thumb. And most of these B and C class properties fall into the 60 and 70% of OPEX to income ratio. And that's assuming no RUBS is implemented. RUBS is ratio utility bill, and basically the owner can pay the bills but still charge them back to the tenants with certain rules. We'll have a video about RUBS pretty soon. So 50% rule if you're B and C class properties and you have well-maintained property and you make some assumptions and tenants pay their own bills. 65% rule when you have not a lot of information, but you know at least that the owner pays all the bills. I mentioned earlier that A class and D class properties will not fall into the 50% rule. And the reason these properties don't comply to the 50% rule is twofold, right? And it's the opposite directions of the percentages. So an A class property will usually have a lot less maintenance tied to it because it's newly built properties. These are very nice, sturdy, well built properties, and they also command high rents. So very high income and low maintenance because of the newly built property. That really drives a OPEX to income ratio of about 30 to 40%. D-class properties are on the opposite side of the spectrum, and they will usually have a lot more deferred maintenance, and they will usually be in a worse shape. That's why they became D-class properties. The population in D-class properties usually don't show pride of ownership. So over there, because you're going to need a lot more labor just to keep things together, you're probably going to need somewhere in the 60 to 70% OPEX to income ratio, maybe all the way up to 80% if it's an old bills paid property. I'd like to thank you for taking the time and watching this video. My name is Joseph Guzlan, again from Eureka Business Group. My email is joseph@ebgtexas.com if you have any questions. And if you'd like to see more of our videos, look at the bottom. There is a link here, and you can get to our YouTube channel through http youtube.ebgtx.com, and we have a lot more videos for you to watch. Thank you.